we are a full-service regional bank, and we are active from all the way from the Twin Cities, of course, all through Wisconsin and down into Illinois, as well as in other parts of the country through specialized lending areas. So we are lending and seeing loan growth now, both in larger corporates, middle markets, throughout the footprint, particularly actually in this part of Wisconsin at the moment, as well as Chicago. It's fair to say, and we were talking about this at breakfast, that small business is still struggling. A lot of the smaller community banks are not in a position to support small business, and they're the normal lenders to small business. So larger banks, including us, are actively building up our capabilities to lend to small business. One of the unfortunate realities is an awful lot of small business, and I'm talking about small business, usually entrepreneurially owned, has gone through a very tough period of time. And so a lot of these companies are not as creditworthy as they used to be. And so with the added scrutiny of regulation and with everything that the banking system's been through, there are a lot of small businesses that do find it hard to provide appropriate collateral in order to get credit. So that's an issue. One of the reasons why we focus so much on SBA lending and why we've been the largest SBA lender here in the state for many, many years is that we need to give small business another avenue. If we can't make that loan directly against the creditworthiness of the company, we need to try to find a different avenue to help small business, and that's why we spend an awful lot of time on SBA lending. Well, there's no doubt branches are expensive. Branches are incredibly expensive, and we're spending a tremendous amount of money to improve the look and feel of our branches. If you go back, I've been in this business now for 30 years. Back in the 90s, there was a prevailing thought in the banking industry that we don't need branches, everybody's going to go to the internet, everything's going to be online. And so banks started closing branches right and left. In California, for example, where I worked at the time, Wells Fargo and Bank of America closed literally hundreds of branches between the two of them. That didn't work. They've opened back up all those branches and more. And in fact, the larger banks who can afford it continue to expand and build branches. And the reason is that the consumer wants all channels available. So yeah, they might do all their transactional banking online or at an ATM machine or on their smartphone. But if you don't have a branch, then you're just not going to be as successful in penetrating whatever market you're in. You've got to have a branch so that people can come in, open that new account, apply for a loan, and there's sort of a psychological desire for people to come, and this sounds dumb, but I've actually heard it more than enough times that I believe it. They want to know where their money is. They want to visit their money. They need to see a physical location. And so, as painful as it is, the banking industry has to provide access through all channels, including branches. The Great Recession was incredibly painful for the banking industry in so many ways. There are still an awful lot of banks, including some here in Wisconsin, that are not going to come out the other end of this. They're not going to be able to recover. They're not going to be able to climb out from underneath the bad loans that they've got on their portfolio. You can get yourself into a trap. Fortunately, we were able to take action quickly and access the capital markets, which gave us, if you will, the financial strength to deal with our problem loans and get them behind us. But at this point, there's an awful lot of banks that are still struggling with that, and they don't have access to capital. And so at the end of the day, they're going to get taken over by the FDIC, or they're going to have to do a relatively painful sale of themselves to someone else. So we still have a period of at least a year until the weaker banks are shaken out of the system. That'll also then lead to a lot of consolidation in the banking business. People have been projecting that this year. Certainly by next year, you're going to start to see a lot more consolidation. And the reason for that is with all the regulation that's come down on banks and the amount of capital that is now expected to be carried by banks, our shareholders here expect us to give them return on the money they've invested. Not just us, but all banks. So we have to get a reasonable return on capital, and the truth of the matter is that's going to require really large consolidation across the U.S. More and more banks are going to merge together in order to get more efficient and get a better return on capital. So you're going to see an awful lot of that going into next year, and in particular, going back to the smaller or weaker banks, those banks that still have TARP money outstanding next year, the clock is going to start ticking because starting in 2013, the cost of that money ratchets up very dramatically. There was a 5-year dividend cost in TARP. That changes in 13. So once you get into 12, smaller banks without access to capital, even private banks, privately owned banks that have TARP, are going to be sitting around trying to think of how are we going to pay this back before it gets really expensive. By the way, I don't have any access to capital. What are we going to do? And I think there's just going to be an awful lot of consolidation driven out of that as well. It's going to be very difficult for the banking industry to get back to the same level of returns that you saw 3 or 4 years ago. Some of those returns, frankly, were artificially high based upon relatively low capital that was being carried around and some pretty aggressive business practices too. We're not going back there, but that said, at the end of the day, the banking industry has to deliver a reasonable return on capital, or you're going to have serious problems because, you know, investors don't have to buy bank stocks. They can buy other stocks. For the economy overall, it's critical that banks are healthy. Banks are a critical component in keeping the economy moving, keeping money flowing in the United States. So something will have to give. Right now, banks are beyond unpopular in Washington and across the country. No one wants to go to bat for the banking industry. We saw what happened in the Senate last week where, you know, a very reasonable amendment to take a look at the Durbin Amendment. Durbin Amendment is the amendment that has to do with transaction fees for swiping debit cards. A reasonable amendment to at least take a 1-year pause and figure out what this really means was defeated. So now, come July, there's going to be a transfer of anywhere, you pick the number, $8 to $12 billion of revenue from the banks to the retailers. Now, of course, you can all expect to see Walmart, et cetera, reduce costs, and you'll all feel that, I'm sure. But the fact of the matter is, we didn't even get a chance to study what happened. And Durbin was tacked onto Dodd-Frank at the last minute with absolutely no debate, no study, no nothing. It just got approved. So between that and other changes in fees, there's an awful lot of pressure on banks on the revenue side. So it's going to be very difficult for banks to overcome that. For us, we're focused on giving our customers a much better experience. We're doing a lot of training in our branch system on improving the customer experience. We're spending a lot of money making the branches better. We've rolled out a new mobile banking app a week ago Monday. So what we're trying to do is give our customers everything they want so we can deepen our relationships with them and make money that way rather than go down the path of trying to figure out the next fee to charge people.